Welcome, everybody, to the Chinchilla Pickin' Podcast. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. It is March 23rd, 2023, around 6 p.m. My name is David Underwood, and I am joined by Brandon Beaver. Brandon, how are you?
Doing all right. How about you?
I'm doing well, man. I am doing well. So much news since the last time we recorded. We had a break. We had problems with schedule. We had St. Patrick's Day, the NCAA Madness. We just couldn't get connected. We apologize for that. If you're one of our listeners that listen every single week, we apologize for that. But we are back, and there's so much to cover. I mean, I don't even think there's really we're not going to have a shortage of things to talk about today. There's so much since the last time we recorded a podcast. But I do want to add a little bit of fluff before we get started. A little bit of fluff here, if you don't mind, Brandon. Patience. So I've been coming on here talking about my weight loss with F45 training in Liberty Center, and the coaches there are wonderful, great people. They work with me every single day. When I went there, again, guys, I went there and I weighed in at Christmas at 315 pounds. So as of this week, I have consistently stayed under 275 pounds. So that is a 40-pound plus weight loss so far in just a 3-month period. And I'm feeling lighter and better. My pants are feeling like I'm almost ready to start buying new clothes. I don't want to jump the gun on it. But yeah, my goal is 230 by October. I think I'm going to hit it, Brandon. I think I'm going to hit 230 pounds by October.
I think you will too. I think that you're determined to do it, and determination just makes everything much more likely.
Right? Yes.
You look good too.
Yeah, thank you, man. Thank you, Brandon. You know, you're not my type, man, but thank you. But yeah, no. So much has happened, guys. So much has happened. I think we better just get going, and I think that's all the fluff we have, unless you had something you wanted to add.
No, I'm good.
All right, cool. So there's a lot to talk about, guys. So rules. Brandon and I get together before the show, and we tell each other what we're going to talk about. You hear the live discussion here on the show. Brandon, where do you want to start? Actually, you know what? Do we want to start with the banks? Because that's what everybody's hoping we talk about. Or do we want to start with some of the other news? There was a big news story today I was going to bring up on top of the banks, which was Block and Jack Dorsey's company. But do you want to start with the banks?
Yeah, and a lot of it's all interconnected other than the Block thing. I mean, inflation, the bank failure, all of that.
So let's start with the banks, and let's go with the banks, see where it takes us. You go ahead. Do you want to lead us off, or do you want me to?
Yeah, sure. On March 10th, Silicon Valley Bank, one of the prominent leaders in the startup ecosystem, collapsed. And then federal regulators stepped in to try to calm the markets. Now, the Federal Reserve had just absolutely ultra low, near zero rates for years. They began raising them in 2022 and 2023, which I think is actually just a continuation of what they meant to start doing in 2018. But with a much bigger job ahead of them after the increase in the monetary supply during COVID. So you've got kind of the situation going on right now. Are we going to conquer inflation, or are we going to calm the banking sector? It's a tightrope that they have to walk for sure. And everybody's saying inflation's easing, but I mean, really, like, look at the core of inflation, dig into the numbers real quick, because you still have price growth in food, energy, and especially shelter. For example, grocery bills up 10.2% in February from the previous year. Energy up 13.3%. New vehicles up 5.8%. Still, go ahead, Dave. I think you had a question.
Well, I mean, I did, because you kind of breezed over that past history there, and I didn't know if you were going to get back into it or not, but I wanted actually to give a little more detail on that lead up and past history, not just kind of do a 30-second, this is where we got to here. I wanted to talk a little bit more about that, and you'll see my reason why, hopefully, when we get to the whole end. That way everybody who's listening gets a bigger picture of why these things are important to pay attention to. So back in 2008, we had a recession, and we had to quickly cut rates at a very excessive speed, and we started a program called quantitative easing, where the government would come in, buy bonds, and buy mortgages in bulk. And the quantitative easing and the interest rates. The quantitative easing was meant to taper off and stop, and the interest rates were meant to slowly go back up once the economy got on a solid footing. Well, the economy got on a solid footing, and neither of those two things happened, right? And so the federal interest rate stayed at near zero or zero for a extended period of time, and it went negative for a little bit. And quantitative easing kept going on, and we got used to easy money just flowing in from the government because we could always print more. Well, the problem with that is COVID hit, and what Brandon was talking about, the monetary supply growing, was whether or not you agree we had to do certain things, because there's a disagreement among all political beliefs about what we had to do during COVID and during that pandemic. No matter what you agree with or don't agree with in doing, we basically, the government, United States, printed more money in order to cover all that pandemic help that we gave out as a country. And so by doing that, when you increase the supply of money, by creating more, they didn't just, the U.S. government doesn't just always just find ways to pull more money. They just create more. They just make more out of thin air, and then they have a bond that they sell to themselves, and then they say, we'll promise to pay this back, or they sell to another country. And so you give us $30 million on a 10-year bond or 30-year bond, and we'll pay it back in 30 years with all this, and all those interest payments we'll make on it every single year. That's how the U.S. government raises money, is by selling bonds. Well, when we had to raise all that money during COVID, and the supply goes up, that means the actual value of each individual dollar will go down in value. Thus, inflation is what happens, right? And it's just like a stock. So the more, when you add more shares of a stock, the price of that stock theoretically should go down because now it's diluted more. And so that's what happened with the US dollar. Now, you fast forward to where interest rates are still at zero. Inflation now has grown tremendously. We're at a point to where they're seeing inflation go up, and they're starting to call it transitory. And Brandon and I had talked about this on the show, about how, this is what the Federal Reserve is probably going to do. Brandon called it out to a T. He played that playbook. Like, if you could go back and listen to that show, I forget what it was called, but Brandon called it out to a T about what was going to happen with the Federal Reserve and Federal Reserve chairman. And it did. It happened that way. And because they were so slow to react, to raise interest rates, you saw all these bonds being bought by people, right? And banks. So you have all these banks buying bonds at interest rates near zero. So what happens when the Federal Reserve starts raising rates in these bonds? The bonds
become worthless that they bought already.
Yeah, the bonds become worthless. So you have all these banks and all these people and all these countries that bought all these hundreds of billions of dollars of bonds, and interest rates start going up at extremely fast rates. Now all of a sudden those bonds are worthless. What happens to all that money that those banks invested in it? It's disappeared. They just lost it. Now, the problem with that is, well, the banks don't play with their own money. Well, they do, but they don't, right? So when Joe Smith down the street, or Roger over there, and they go down to the bank, or Lisa, they go down to the bank and they give the bank 1,000 of their money. The bank turns around, takes 1,000, and they either they take a loan out against that 1,000, and they use that to go ahead and invest with and give out other loans with. Now, when they lose that initial 1,000 loan goes bad, they got to pay it back. So where did they take it from? They take it from Lisa and Roger and John, and they use that money to pay that back. So now the bank has no money in it. So when Lisa goes to pull out her $1,000, there's nothing in there, and the bank can't pay it. And that's why you have the federal government stepping in and saying, hey, we have insured all FDIC insured accounts up to $250,000. Well, the problem with that, with SVB and Signature Bank, is most of their accounts, I believe it was 95%, correct me if I'm wrong, 90 to 95% of their accounts were not insured eligible. So that means that none of this money was insured. And even if those accounts were in the tens of millions. So 250,000 of tens of millions is really not enough to save whatever those accounts were. And they need that money to make payroll. And thus, that's where you get this trickle effect of how it systemically trickled throughout all the businesses and everything that happened, and why they got concerned. Is that a good explanation, Brandon?
Yeah, and Roku, I think, had, was it 400 million? Over $400 million?
Yeah, they had a ton of money in there. Yeah.
Yeah.
Roku was, yeah, they were in bad shape with that one. There was a lot of companies in bad shape. Now that brings us here to an issue that you and I had talked about in a group message, and I'm going to say my piece here. I'm going to try not to be political about this. I'm going to try to maintain a financial and investment advice and viewpoint on this, but I'm going to bring this up, and the term I'm going to talk about is moral hazard. And if you guys don't know what moral hazard is, there is a lot of good shows out there. There's a Big Short. You have Money, Wall Street Money Never Sleeps. You have a lot of good stock investment movies that are entertaining, and they also will teach you a few things. Margin Call is a great one, but Margin Call is kind of boring if you're not into stocks and investments, but it's great for the rest of us. Moral hazard is if you go ahead and you save a company or a bank, right? The government steps in and says, hey, we'll save you, we'll backstop you, and we'll save you. What's to stop those banks from doing it again? Because now they know that the government's just going to come in and save them. So there's no risk. There's nothing bad that's going to happen. That's what moral hazard basically means. And so my problem with this is that majority of all Americans, Republican and Democrats alike, after 2008, all agreed at that time that, hey, we should have let some of these banks fail. Majority of Americans said that. That was across party lines. We were united with one thing, saying, put it to these banks. We're sick and tired of them making bad decisions with our money, and playing derivatives and leveraging everything to 150%. That's ridiculous what some of these people were doing. And we were upset as a country. So you fast forward to now, and you see the headlines, was it last two weeks ago? The headlines coming out, and what's the first thing we do as a government? We step in and we say, hey, we're going to backstop all this here. We're going to make sure there's none of this here. And the first thing I sent to Brandon in our group chat was like, let them fail.
Yep.
The FDIC insured accounts, let's insure those are insured. Let's cover that. But let them fail, because these banks and these people are never going to learn the lesson if we continue to bail them out. And that's just my opinion. Okay. That's all it is. It's not a fact or anything. Maybe I'm completely wrong in that viewpoint, but that was my viewpoint. And I just wanted to say that because this is my show and I own this company and I can say that if I want to. All right.
Now
let them fail.
I agree 100%. 100%. And you mentioned the margin calls, and I think that everybody should know what a margin call is, because as an investor, you should be able to step in and take advantage of these things when they happen. Outside of a steep recession and things like that, absolutely, I love margin calls, because there is no shortage of people with a lot of money that make bad decisions. And if somebody has to go out and sell, 5 million shares of Apple because they're in debt to somebody else and it has nothing to do with Apple, and it drives Apple's price down and creates a little panic in that stock price for no good reason, yes, please let me buy that at a lower price. It makes me so happy to do it.
Right? Exactly. So if you guys follow us on Instagram, Monday morning, when this all first was really breaking out, I got on Instagram and I posted a video, and on the video, it was like 8 o'clock Monday morning before the market even opened. And I said, guys, First Republic is down a ton right now. And I went on there and I said, you need to buy First Republic Bank today and do a quick day trade. I even said it was a quick day trade because this is going to pop right back up. And the reason for me saying that, and this is how you make money at times like this, the reason for me saying that Monday morning was because the U.S. government came out and said they're gonna at that Monday morning. Now they've changed their statement over the last 2 weeks, but Monday morning they were going to come out and they were going to make sure that First Republic does not fail. And I was like, the U.S. government's coming out publicly saying that this is not going to fail, and this dropped 60%. I'm buying this because it's not going to go back up that full amount that it dropped, but it's going to go back up a little bit, and I'm going to make a little bit of money, and I'm going to make it quickly, and I'm going to make it within a day or two. And sure enough, less than 24 hours, just Monday during the day, I day traded First Republic twice, and I made 30% returns. And we were in our group chat, Brandon and I, going back and forth about these trades we're making. And we had another guy in the group chat. How much did he say he made on Monday off of First Republic? 54%?
I think it was, yeah. 54%.
Yeah, he made 54% because he listened to us. And this is what Brandon and I are trying to teach you guys, is how to catch these moments. So when all this stuff is happening, you're finding opportunities to make smart investment. That's where Brandon gave the Apple analogy just now, is look for these opportunities to jump in when something's going to go. Now, First Republic was a day trade, and I specified that when I said that. I was like, this is a day trade. Quickly, in and out, guys. Do not hold this. And I still specify that. So if you're going to get in and out of it, it's risky right now. It's very risky right now because it's been going down. But, that's what I'm looking at right now as far as these banks go, is day trades. Brandon, go ahead.
From peaks to troughs, you had 2 opportunities in 24 hours to make to double your money on First Republic.
Yeah, it was crazy returns. And that's just another example. I was happy to take 30% in one day, but that's another example that, like, peak to trough, you could have doubled your money twice. I'm not even, I could have had a 200% return on my money, or even more, because when you compound the interest, it would have been 300% almost return on my money. But I am so not that smart that I only made 10% of that 30%. So no one ever really times the top and bottom. So you can't really try to time top and bottoms, guys. If you're up and you're up over 5% in a day trade, that's my rule of thumb. If I'm up over 5% in a day trade, I'm out because I made my money and I'm happy.
Yeah. So are you buying the banking sector right now that it's being beaten down? Because I'm not.
I'm not. All right. Because we have not seen enough of this fallout from these banks. Like the Credit Suisse, there was a lot of different mutual funds and investment funds that were, invested in these bonds that Credit Suisse is holding that is worth nothing now. Like you said, they're worth nothing. So what's happening with
that? Credit Suisse comes out and says, "Oh yeah, from 2020 to 2022, we have a lot of accounting issues, and we have no idea how much money we made or lost."
How is that even possible? You're one of the what, top 50 banks in the world? You would say top 50? Yeah, top 50 banks in the world, and you're going to come out and say we have no idea how much money we made or lost in a 2-year period.
This was during the period when COVID was happening, and I know it's a Swiss company, but still, banks across the world were seeing large amounts of capital coming to them, like record amount of deposits because of, the stimulus that we were getting. So quite frankly, from 2020 to at least 2021, they should have been doing great.
They should have. Yeah. I don't understand what happened there. And the Swiss banks are known to be solid companies. Like, you don't expect a Swiss bank to have issues like this unless there's a worldwide crisis. You expect Swiss banks to be solid, but they weren't. And that scared a lot of investors, and a lot of people were like, hey, even the Swiss banks are doing poorly right now.
When a bank comes out and says, hey, we don't really know how to bank, it's gonna scare people.
Our accounting department is not too good. We don't know how much money we made or lost. You're a bank. That's like your only job is to manage money, and you can't even do that. So yeah, it's ridiculous. And they got bailed out by Switzerland. Switzerland stepped in and helped finance the buying of Credit Suisse by another Swiss bank. So they got bailed out there. And I think Switzerland did that to keep Swiss banks strong. They wanted to show that they were able to help that. And I think that's a nationalist move on the part of Switzerland there to make sure that they keep, hey, Swiss banks are good. We're good. Okay, we're good. And I think that's what they were trying to do. Back to an American system here, they're worried about the regional banks and the fallout of everything that's going to, the trickle effect of all these losses. Yeah. What's it going to have on these regional banks? And you've heard all kinds of things of, regulations were scaled back. So now we don't know how much damage is going to be done. Regulations were scaled back, but there's still a lot of the Dodd-Frank rules and a lot of the 2008 rules that are put in place that are still there. They're meant to have X amount of cash on hand to cover losses. The banks are like the big banks, JP Morgan, just Q4, they reported great numbers. They have lots of cash on hand. They were very profitable. They're going to be able to be just fine. The big banks are going to be able to just fine. That's why the concerns in the regional banks. They don't have as much cash on hand because they didn't need it because they weren't as big as the JP Morgans. So the concern is, is the fallout going to be this? Are we going to see consolidation? Because in America, we like lots of choices. You like to be able to go around the country and go to a PNC, a Wells Fargo, a United Bank of California, or some other regional bank that you have there. Key Bank's another regional bank. First Republic is a regional bank. You want to be able to go to all these different banks and pick and choose which one you want based off the services they provide. Fifth Third is another regional bank. And we don't want to see a consolidation to where it's just 4 or 5 banks to choose from. We want to see more variety of that. That way, there's competition and they provide better rates and returns. And so that's why Janet Yellen came out on TV today, and she said, and I have this pulled up because I want to quote correctly. Oh, I don't have it pulled up anymore, man. All right, so I'm gonna try to summarize her quote today. That she came out and she said that they're gonna go ahead and backstop or protect and cover any bank that may pose a systemic risk to the financial system. They will make sure they do not fail.
But last week she said that the banks were resilient and strong.
I know. I think
what do you have?
I think what they're delving into the numbers more, and they're seeing just that the banks have never learned their lesson from 2008. And here we are again, and they are not as resilient as strong as they thought. So she's putting out that statement to prepare the way for some of these smaller banks to fail and to prepare the way for the government to step in and save them, like an AIG type of saving is what I'm thinking. If you guys don't remember AIG, the government at one time owned over 60% of AIG. Yeah. Now AIG did turn it around and they paid back the U.S. government with interest. The U.S. government made money off of that deal. They did pay back the U.S. government with interest and bought back their shares from the government, but the government had to do that in order to save that company.
AIG's been making some pretty good calls over the past year and a half. So that actually surprises me. I think they actually came out to be an exception to the rule. For example, I normally wouldn't, advocate for a banking, well, it's not a bank, but an insurance company or a bank to play with options, but they had an April 2022 put on SPY, and that wound up being just perfect for them.
Yeah, that was a good call.
They called that right.
That was a very good call.
Yeah.
Right now, Brandon, are you seeing any banks or anything in the financial system that you're looking to trade or buy or invest in?
No, but you know what? I tell you, I almost bought PNC Bank when the Credit Suisse thing happened, because Credit Suisse has absolutely nothing to do with what's happening in the American banking sector. That's just idiot management. Sorry to be crude, but it's true. It's just bad management on their part. And their downfalls actually, it doesn't really have much to do with anything that's going on right now. I'm sure it's exacerbating it because the ECB is going to have to raise interest rates higher than the U.S. government's going to have to raise them. So, they're probably facing more future potential problems. But just that news that they didn't know what they were doing between 2020 and 2022, you're not going to find PNC Bank management coming out and saying the same thing. However, one of the reasons why I don't invest in the banking sector, whether you like it or not, the Dodd-Frank Act, you could say it limits the risks of the banking sector, but it also greatly limits growth. So, when you were looking at the financial sector earlier this year, I was staying away from it then too, because the price to earnings ratio of these things were all of a sudden 15 to 16. Times earnings for a banking sector that's luckily, it's lucky to grow 3 to 4% a year when we're in really, really good times. I still don't see myself buying into banks, even with price to earnings ratios of 8 to 9 right now. It just doesn't make any sense to me. But I will tell you,
Berkshire Hathaway, is that not an investment bank?
But here's the difference. So it has investment banking, right? But it's got a mountain of cash. And it also is exposed greatly to the insurance sector and to tech and to groceries and staples and all kinds of things like that as well. I think that what you've seen over the past couple of months is probably going to continue. The stocks that are going to outperform are going to be the companies that are sitting on a boatload of cash, your Apples, your Googles, your Berkshires. Those stocks are the ones that are going to continue to outperform as people kind of, leave the banking sector and try to find some place else to put their money. looking for safety, actually, like big tech and Berkshire Hathaway as well, even though it's not big tech, but those companies with a big cash amount, large amounts of cash that they're sitting on, they're going to be seeing a safety.
Big tech really led the rally today, all across like Microsoft, Google, all the big names, the FANG stocks had somewhere in the area of 5 to 8% returns just today alone. And so, I mean, there's your day trade, 5%, right? But big tech really led the rally today. And I think other people had the same idea you have, Brandon, which is put your money in some of those other in stocks and the companies to see some real growth.
Yeah, and you know what? I did all my buying, months and months ago, when Jim Cramer was crying about Meta on television. That's when, we were buying Meta and buying the Googles and stuff. And so I'm
Well,
set.
I tell you,
I'm set right now, but
right. I mean, so so if you guys have listened to us for any set amount of time, Brandon and I had different styles of investing and trading. Brandon he usually does, typically, correct me if I'm wrong, long investments, and most of his money's tied up in those investments. Versus me, I've let's just say my accounts are a little bit more mature, and I have enough to have my investments, and then I have a day trading accounts. Yeah. To where I have money that I set aside just for day trading. So I'm constantly actively trading all the time. So I'm always looking for investment in different ideas. But yeah, your tech was definitely on the hot list today. I was definitely eyeing them, but it was too late. I'm not going to chase a dragon or chase a wave. The wave I missed it. I got to wait for the next set to come in before I can ride it. But what I am viewing is companies. There's a lot of companies that flew under the radar here, and people aren't really paying attention to, I think, going forward. Unless do you want to talk more about the banks?
I mean, I have more on it. I don't care. We can go either way.
All right, so let's venture off. We could bring the banks back in if we want to. There's a lot of companies, guys, that flew under the radar here, and I want to highlight a few of them. Number one, Blink Charging has fallen 50% in value from when I was talking about it a few weeks back. And I was saying that I would post if I ever thought it was a good time to trade. Obviously, I never posted, so I never thought it was a good time to trade. However, since it's fallen so much in value, one of the big headlines after it dropped below $8 a share was that it signed a deal with the United States Postal Service to be their sole charger for all the United States Postal Service vehicles in their fleet, the electronic vehicles in their fleet. And I was like, wow, that's a huge deal, right? What happened? Blink stock dropped. Why? Because the whole market as a whole is dropping. So this goes back to my boat analogy, man. Rising water lift all ships and also sinks all ships, right? But sometimes it sinks ships that have no reason to be sunk. And that's an opportunity to go in and buy. Am I coming out and saying Blink is an obvious buy right now? Here, I tell you what, I'm going to look it up as I'm talking, and we're going to see where Blink stock is at. And I can tell you whether or not it is a buy right now. So Blink is still, go ahead.
They have no exposure whatsoever to like a bank like Silicon Valley or anything like that.
No.
That's probably why they dropped. That's
they dropped because the market was dropping, right? So they're at $7.49 right now. I would say Blink's a buy right now at this price, just because of the deal they inked with the United States Postal Service. Means there's going to be other deals going on with Blink. We're going to probably see more deals because of the act that was passed that's going to funnel money into this sector. We're going to see more deals coming out of Blink. Another one, there's another one I want to talk about that flew under the radar that had huge news and has just fallen completely off the radar here. And I want to try to pull up this article I read here. I'm looking for it right now as I pull it up. So I talked about this company before, and it is Cooler Technology, right? And it is just completely fallen off. It has dropped tremendously. And everybody's like, why are we still talking about this? This company has fallen down to like really low lows. What is going on? Well, here's the thing, guys. Cooler Technology did miss on their they beat their earnings calls. The estimate was to have a loss of 5 cents a share. They beat that with a loss of 4 cents a share. Q1 was the first quarter that they were going to go ahead and start selling products. So this is a brand new company, just a few years old. They were in the whole stage of developing their technology, right? So you have to have like contracts with companies, say, hey, can we test this out with you? Can we test this out with you to see if it works here? And they did that. They tested out NASA and the government and Boeing and all these other companies were using. Northrop Grumman was another company that was allowing them to test their technology, and it was turning out good. So they started inking a couple deals last year, at the end of last year, and then they say we're going to actually commercialize come Q1 of next year. And so that was one of the things that everyone was looking forward to seeing was Cooler. Can they go ahead and make a profit now that they're going to go ahead and commercialize this business? Well, one thing that really caught my eye, knowing now that they are looking to go ahead and try and grow the company and sell the product, they built a research and development center in Texas, very near to Tesla. And then the CEO of Cooler comes out on comes out on TV and saying, "Thank you, Elon Musk." I'm going to get this wrong because I couldn't pull it up, but it's thank you, Elon Musk. We look forward to thankfully, Elon Musk has done the math on sustainable electrification economy. Cooler is happy to be part of Tesla, happy to be part of the Tesla vision. That tells me, because what Tesla is all EV vehicles. Cooler is deals with making batteries safer, last longer, and improve them. I see that there's either a deal that's going to be made here to where Cooler is going to be working with Tesla completely, or Tesla's going to buy out Cooler. And that is the two options I see with these moves by Cooler and with the deals with Tesla. Now, Tesla is working to create their own EV chargers for cars outside the United States. So globally, they're going to be producing their own and putting them out there because in the United States, there's a lot of competition. I think that this is a good time to buy a beaten down stock Cooler, because if it's a big deal that they make with Tesla, that's a lot of revenue coming in. You're going to see the revenue probably go up tenfold. Or B, if it's a buyout, you're going to see the stock go up tremendously in value because Tesla's just going to buy them out because they're still cheap right now. Brandon, your thoughts on the news I just broke to you about Cooler?
I think a Tesla buyout is probable, but outside of any new, me, I like to buy the buyouts when they've been announced, and then make my 5 to 6% over the course of a few months. So I mean, it's
Slow
not my
growth.
play to buy it right now, but I don't disagree with anything you said.
Right? It's just the Twitter account. So it sounds like the Cooler CEO is kind of like Elon in that they're probably disclosing a little too much over Twitter than what they should be doing. But it's good news if you're holding Cooler stock like I am, like a bunch of other people are. That's one of my long-term investments. I've been very public and vocal about, hey, I own this long-term because I like the company, I like where it's viewing. And so, this is definitely something I see positive for Cooler Technology. I see this as an opportunity for them to strike either a big deal or get bought out because Tesla sees what they're doing with batteries, and that's Tesla's main deal is electronic batteries. So I think this is going to be a good deal all around for Cooler Technology, and something big. It's going to be announced shortly, and I really feel that this is a good time to go ahead and buy into Cooler because it's so beaten down if you don't own it. And it's a long-term investment, guys. I've owned it for almost now 2 years, and I thought it would take about 2 years before we saw some real results. So I'm kind of right on the right timeline here. I think we're going to start seeing the real results now, and this is going to be either one of first few big deals they make or a potential buyout from Tesla. So I'm loving the stock right now.
Yeah.
Brandon, I did want to talk. I want to mention one other headline to other people, and then I want to talk about this whole block thing. I mentioned it to you before this show as something I wanted to bring up, and so I want to just read this one headline, but it's nothing to do with block. This is completely separate from everything else we talked about. Well, actually, two headlines I want to read and just throw out there as information for people out there, so everybody knows what the World Bank is, right? The World Bank basically is a financial institution that gives loans to emerging countries that can't get loans anywhere else, and they provide them with capital to build roads, infrastructure, help their economies start businesses, so on and so forth. Well, the World Bank president, David Malpass, on Thursday, he came out with a new roadmap for private sector participation in project financing across emerging and developing economies. What he was saying is the World Bank needs help, and we need the private sector to jump in and help us, and we need $2.4 trillion in yearly financing needs from the private sector so we could continue helping emerging economies. The problem is the private sector only invests to make money or produce return for the people that invest with that bank. And so if these emerging economies aren't really always, it's just basically like subprime loans, really. And so it's not really a good thing that the private sector is going to want to invest in. So he'll probably get some money, but he's not going to get all the money he needs. I just found it weird that he went publicly and was asking for that type of money out there. The next thing I want to mention is just another quick headline. I'm putting this out different. Oh, you looks like you have a comment about the World Bank.
I just, yeah, I mean, sometimes I feel like they're just looking at the situation and they think that, like, it'd be a great idea. Let's spread the risk.
Yeah, that's and that's because the World Bank's funded by countries, guys. It's not funded by private citizens. So yeah, we don't want to spread the risk to private citizens. We don't want that kind of risk on our portfolio.
What we did in 2007, from 2001 to 2007?
Yeah.
Let's do that with countries.
Right? Yeah, that's crazy. All right, and so the next quick headline I wanted to mention, this flew under the radar the past 2 weeks, but I did want to mention this. With all the bank news and everything else that happened, there was one company out there that quietly reported their Q4 profit, and this is Saudi Aramco. So if you don't know this company, please Google them, look them up, find out who I'm talking about. Saudi Aramco reported a profit, guys. This is profit. This is not revenue. This is not top line number. This is their bottom line net profit. $161 billion for Q4 of one quarter of last year. $161 billion. That is outrageous. Outrageous for one quarter.
Oh my gosh.
You want to talk about a monster quarter and a monster company now, because now they have $161 billion that they're going to put to use. They're probably building that wall city by themselves. That's probably just they're funding it themselves with the profit they make. And if you don't know the wall city I'm talking about, guys, Saudi Arabia is building a city that's on a line or a wall, and it's not just something of the imagination. They're actually building it right now. They have parts of it going up and the infrastructure is being put in place and it's being built. It's going to happen. And so Google that. That's another cool thing to look at. You can see the pictures, the renderings of how it's going to look when it's done. But anyways, my point being that, Saudi Aramco is pulling in tons of cash and they're going to have lots of money to invest with and do other things and invest outside of oil, which has always been the goal publicly. That Saudi Arabia said this for years. We need to put our money to use outside of oil because we're going to run out of oil eventually. And so that's what Saudi Arabia has always said. And so they're going to continue to do that. But yeah, it's crazy how much money that company made Q4 last year. Crazy. And just flew under the radar. All right, guys. So here we go. Let's talk about. Go ahead. Yeah.
Forgive me for this. It's not traded on American exchanges, though, correct? I don't think.
I believe it is. Let me check.
Is it?
Yeah. We both come on, man. We both have our phones out right now. People are listening to us, Brandon. Come on. Get your phone out. Go in there real quick. Type it in. See, guys, this is how long it takes.
Yeah, I don't think it is. I think it's a Saudi stock exchange.
It is. All right. There you go. Crazy.
But you do have the MSCI Saudi Arabia capped ETF, which I'm sure is greatly exposed at least a little bit to that. But oh no, they're 42% financial services. Never mind.
Man.
Ooh.
All right. I don't know. All right, guys. The last story that we're actually going to have a discussion about. This is not me just reading off a headline, Brandon. I'd like to get your opinion on this. And I mentioned to you, and that's why I told you about. I would talk about this on the show ahead of time. Is Block shares. If you guys don't know what company Block is, this is Twitter co-founder Jack Dorsey when he sold a lot of his shares from Twitter and no longer became CEO, he started this company called Block, and he wanted to go ahead and reach out to underserved communities around the world and provide them a way of banking and financial transactions, right? So he had good purpose behind it. You might know one of the bigger parts of this company by one of its names, which is Cash App. You might know more from that name than anything else. So Block or Cash App here, Block shares have been down a lot. So it grew very fast. If you look at a 2-year chart on this, it went uphill like it was a rocket. You would have made a ton of money if you invested with this company. And it started coming down just as fast because it all started when other companies started taking a look into Block or Cash App's accounts. And what they were seeing was worrying to them. They were estimating, and this is India's Adani Group, who first started looking into it and made this public when they looked into it. They said they estimated that 40 to 75% of accounts that they reviewed were fake or involved in fraud or additional accounts tied to a single individual. Which, if you use Cash App, you kind of know that there's a lot of these fake accounts out there that are trying to scam you out of money, and there's a lot of people who have like 2 or 3 different accounts with Cash App. That's something that everybody knows. So it's like, okay, what's the big deal, right? They're still making money, right? Cash App's still making money. Block's still making money off of all these accounts, whether they're fake or not. They make money off of them. They make money off the transactions, and so come on now. What's the big deal about them being fake or not? Well, Hindenburg research came out. This is more recent than the India's Adani Group. Hindenburg research came out and they disclosed short positions in Block. And they alleged, let me read it correctly. They alleged that the payments firm led by Twitter co-founder Jack Dorsey overstated its user numbers and understated its customer acquisition costs, or how much it costs to get new customers, right?
Sounds a lot like Twitter.
Yes, right. Yes, yeah. Same person that started this one, right? Block has vowed to fight back, saying they would explore legal action against the short seller for its factually inaccurate and misleading report that was designed to deceive and confuse investors. So Block's threatening to sue Hindenburg because Hindenburg did a short sell on this and then came out publicly with the report saying, hey, look how bad this company is. Block saying, hey, Hindenburg's just trying to go ahead and make money in the short term off of people and investors. Well, right now, Hindenburg is making money because they did the short sell, and Block has dropped a ton recently over the past couple of days. And so right now, Hindenburg is making money. So whether or not Hindenburg takes their profit and runs, or Hindenburg stays on the short, we have yet to find out. But all of this is happening, right? Dorsey has a stake of 8% in the company himself, among other people who are invested in this company. But 2-year investigation concluded Block has systemically taken advantage of the demographics it claimed to be helping, is what Hindenburg is saying. Since this report came out, Block has dropped 60% in value. My thing here is, I'm looking at this, Brandon, and I'm like, I see legal issues with Block, yes. But the point that Hindenburg's trying to make is that it's one person having multiple accounts, or all these other people creating fake accounts to trade money or move money around. And I'm like, yes, but is it illegal?
No.
And so I'm like, if Cash App is making money off of this, why not let them? They found a way to make money off of people creating multiple accounts and doing what they want. I say, if it's legal and they're not breaking any laws and they're not hurting anybody, then allow them to do this. I don't think it's a reason to sell the company as long as the numbers are true in their top line numbers and bottom line numbers. Thoughts, Brandon?
Yeah, the top and bottom line is what matters, and we all know that Twitter used to at least report their user base and stuff like that in their financials, and we've found out that a large percentage of those were bots, which I think anybody, of course, that used Twitter already knew that anyways, just the same way that they know it about Cash App. As long as the top and the bottom line are being reported accurately, I don't really care about that either. I am interested in the fraudulent accounts, though, only because I don't want to be involved in a battleground stock that gets into legal trouble.
Right. I mean, is Is Block going to be another Herbalife where you have activist investor coming in saying that this is being run or horribly, let's short sell this, and they hold that short sell forever? Or is this going to be Hindenburg just really trying to make a quick profit? Now that they did, are they out and they're going to stop and back off?
Yeah, I don't really know much about Hindenburg. I pay attention to Citron because I really respect them and I watch what they have to say. But a lot of these short sellers are just the half of what they say is just untrue.
Yeah.
Well, I don't know about Hindenburg. I really don't know. I'm not making accusations against them. Usually when a short seller comes out and says something, I may investigate it for 10 minutes. I may just gloss over it and then move on to the next thing. But in this case, with the amount of money that Block shareholders have lost in the short-term period of time since the Hindenburg article came out, yeah, it requires a lot more attention than just glossing over. But I just don't know. I don't know enough about the fraud accusations from the company from India. That's where my concern would be. Not really.
And that was a year ago that came out.
Okay.
And everybody kind of brushed that off and said, pardon me, nah, that's nothing. But then it was Hindenburg that just came out recently, and came out of all these other accusations again. So it's the second time for second company.
Yeah.
It makes you question. What's really going on here, Block. And this is, again, like you pointed out, another company Jack Dorsey started that is got some robots, some bots moving in, pumping up his numbers in his business.
And it's not profitable right now anyways. I mean, not consistently enough. So, give me a full year's worth of profitability and then we'll start talking about whether or not I'm going to add it to my portfolio or not. You know how I am with that kind of stuff. But it's just, so yeah, not for me. Not for me at all.
All right, man. I'm not buying it off this dip either. I think there's just too much unknown. I don't know, the facts of the case, but it's interesting to see this type of things happen. You did see a small dead cat bounce today. If you guys don't know what dead cat bounce is, it's when a company falls off an edge of a cliff for whatever reason. They have big news come out and they just completely bomb. They're going bankrupt, whatever, what have you. Waiting for Bed Bath & Beyond to go bankrupt and disappear, but the company falls off and falls down. It's like throwing it, and this is a horrible saying, but this has been a Wall Street saying for over 100 years. A cat falls off and it falls dead, hits concrete, it bounces. Well, a stock falls off and it always has a little bit bounce up. It's called a dead cat bounce. And you can always make a quick 2 to 3% off of that, but you have to time it perfectly right, and that's very hard to do. So yeah, you saw a little bit of a bounce today, that type of bounce today. We got to come up with a new saying. I think you and I could come up with a better saying than dead cat bounce.
It's kind of funny though.
It is kind of funny, but like I think we could come up with a new saying and we can make it popular. But yeah, I think that's what you saw today, and I think it's going to continue lower. Is my view, because there's just too much negativity here, and Jack Dorsey's second company that he has seen these issues at is what concerns me. It's not just the claims; it's the one person in charge who started it. Second time doing this.
Yeah.
That's what worries me. All right, Brandon, final thoughts, man. Final thoughts.
I think it's going to be the tech sector, the big tech names that continue to outperform, not the money losing ones like Block. But I think it'll be the big tech names, your Apples, your Googles, even your Metas and stuff like that will continue to outperform over the rest of this year. If we have a systemic banking crash and things get worse, of course, everything's going to go down. But I think right now people looking for safety are getting into, these big tech stocks. I think at the beginning of this year, people were just like, wait a minute, Clorox is trading at 34 times earnings and Meta was at 10. What are we doing? So, and these big tech stocks, the Googles and stuff like that, they're not trading at the sky high, ratios that they were trading prior to COVID and during COVID. They're not there. They're reasonable right now. And there is a difference between being reasonably priced and being undervalued. I don't think we're necessarily undervalued. But I do think that it could be considered more of a safe place to put your money. Personally, I'm not making any moves right now. Already made my moves, sitting on them and just happy with where I'm at. And, just building cash on the side, waiting for the next opportunity.
Nice. All right, guys. You heard my call. Blink charging right now at this price, $7.49. I'm looking to buy in. I believe that's going to have a good return. I believe it's being pulled down because everything got pulled down recently, and I don't believe it deserves to be pulled down that much. I'm still long in my long-term investment cooler, but I think I'm about to see some returns finally on this long-term investments. I'm about to see some good returns, and so I'm very excited for what's going on with that company. I'm watching that with excitement here. Hopefully that can pay for my daughter's college tuition, because that's going up in price. Look for opportunities, guys. Not every company deserves to be pulled down with the other ones, such as what Brandon was talking about, Berkshire Hathaway, how it's a standout bank, but it's all banks are being pulled down. So that might be an opportunity right there in the banking sector. Be aware, look for these good moments to make a lot of money. Like when I posted on Instagram about First Republic, I knew immediately this was a sure thing for a day trade, but it was just a day trade. And I wanted to preface it with that. Like, this is not something to invest in. This is something quickly trade, make your money in. And it was a good opportunity. And those are things to watch for. It's hard to really time things. You can never time things at the exact bottom or exact high. You just want to set your range, how much money you want to minimum make percentage-wise return on. And then once you hit that sell, it doesn't matter if it goes up another 100%, you made your money and you should be happy. And that's what we try to teach you is discipline and wait for opportunities. Don't go chasing opportunities, or as we call it on the show, chasing a dragon. Don't go chasing that dragon. Wait for the opportunity. Be disciplined. That's definitely a key. All right, guys. We thank you for listening. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.